So this is on the 4-hour, GBP, USD, and there was a beautiful trend. You can see here with this orange. The trend started on July 22nd. We've been in this beautiful downtrend. We broke this trend on August 9th, and we appear to be in an uptrend. I would say we are, because we've already taken out a lower high. This is the lower high. This is the lower low. We came up and took this out. This area right here makes it a reversal. And now we'll keep challenging these points of interest. So we're challenging this one now. While we're here to get into price action, because I think this is a great example of them. You see, we got a doji here. And this is just a 4-hour. 4-hour is pretty reliable indicator price action. I prefer trading on the Q15, but the 4-hour gives you a good grasp of the overall picture. So anytime I see a long wick like that, where it lets me know that it's bouncing off of something, we already kind of highlighted this as an area of interest because we broke structure here. Looks like we tried to make an effort to go back down and we bounced out. We didn't even get close to it. Pretty much bounced back up and made a wick, which is a good sign that the trend is going to try to continue up, but it would need to get through this level because this is lower high on the previous trend.
Would you consider this week a retest?
I wouldn't consider it a retest. So for me, a retest would actually come down and hit this zone, or it would kind of come down slowly and hit it. This kind of seems like it did try to reverse and it just wasn't able to because the market structure here is too strong. So I'll go back to the Bitcoin charts. I've read before, the further apart your rejections are, the more reliable it is. So if you're on a Q5-minute time frame, you see, so for example, this Bitcoin chart, its first rejection was in March. So twice in March, we rejected off of this, again in April. Then we came back in May and rejected off of it, and then again in June. Then we rejected off again in July. Those points are so far apart that means that this is a more reliable area of interest as far as it being a reversal. Whereas if they were all close together, that basically means there's no respect. So a true reversal or a true demand or supply zone is so powerful that sometimes your price can just get close to it and it'll react violently, like it'll bounce off of it extremely quick, right? Whereas if you keep hitting an area over and over and over again, that means there's no respect there. There's not enough buy orders there does that make sense? Like to reverse it quickly. It's like price action is just playing with this zone, knowing that it can push through. If it's a true reversal or a true area of interest, a true demand zone, you'll know because of how quickly it bounces off. And when the trade is going down, it's accumulating. Like us retail traders, we see it going down. And so we sell and sell and sell and sell. Well, when they reverse it, that's when they snatch all our money. For those of us who are not trading with a stop loss or a trailing stop, when they reverse on us, they're using that liquidity to power their move to the upside. So let's say we were trading down. This is all the retail traders. It's going down. We're going to sell. All these retail traders don't have stop losses set and they're just riding it out, being greedy. They haven't secured their profits. They haven't secured partials. And then let's say this is JP Morgan Bank sitting right here who's like, you know what, we're going to reverse this and take all of those. We're going to wipe out all of those stop losses. That'll give us the power to kind of push through. It would reverse here and shoot back up. And it'll try to use that liquidity to kind of push through the zone. For 2 months, we spent time accumulating orders. We took all of them out and we still can't cross over this area. That means that's a very powerful order block. Like, look how we reacted off of this one. We tried again to hit this trend line 3 months later, and we still got knocked out of the park to the downside. That lets you know how powerful it is. And so it's kind of a matter of respect. Like if you see a bunch of orders grouped together, we keep testing an area like this right here. This candle has hit this 1, 2, 3, 4, 5 several times. And although it's showing resistance, if it were truly a demand zone, it would have bounced off of this like really tough and dropped down there. So if the price is willing to even keep going and touching the price over and over again, it's already kind of weak. Each time price touches this resistance area, it gets weaker and weaker and weaker each time because it's hitting it back to back to back. So eventually it's going to touch this area and pop through and go up there. And one of the reasons why is because us retail traders, if we were going to trade this to the downside because we're like, oh, there's resistance right here. So I'm going to place my sell order right here. I'm going to keep entering at this. Well, this is our stop loss area. The vast majority of us will put our stop losses in this area. Well, the banks know that. So after they hit this repeatedly, they dangle it in front of our face. They'll just reverse it at some point and wipe out all of these stop losses. That gives them liquidity to push price up here. So you kind of start to develop like what I call a vulture after a while. You know, like everybody's placing their stop loss. Here's a perfect example right here. I'm gonna move this down. You see right here, how we hit this 1, 2, 3 times. We hit this zone 3 times. So your average day trader would be like, okay, there's resistance right there. So I'm gonna place a buy order here to the upside. And if you had a trailing stop, you'll be fine. But if you didn't, then look what it did shortly after. We went up. We actually even reached it's got to be at least a 1 to 3. Yeah, that's the wrong. That was a 3. Yep, that's a 1 to 3 right there. But because it hit this area of resistance so many times, most people entered at this resistance level and used it to place their stop losses because, natural resistance levels are kind of there for, what you perceive to be your protection. And it goes up, you get a 1 to 3, and then it reverses and plows right through there where it just took out all of these stop losses. It's kind of volatile. It's a good idea to just stick to your strategy. If you're 1 to 2 or 1 to 3, get your money and get out, because anytime you have a resistance level, it's quickly liquidated by retail traders seeing that level and placing their stop losses there. But then the banks will target those levels because the stop losses are all there. The vast majority of what liquidity is taking out retail stop losses. Miss J, explain the part about the stop losses. Okay, so if y'all see the symmetry here, I have a trend line drawn from here to here. When you see a trend line forming, of course, you want to get in at some point during the trend line. A trend line is anytime you have 2 or more points along the same line. So here's point 1, here's point 2. Once you hit point 2 and you bounce off of it, most of us are going to enter at point 3. We have clearly established a trend line. So let's say you come in right here at this third point. You set your stop loss, the most recent reverse, which is here. You want to set it a little bit lower. And let's say your goal is a 1 to 3. Which are about right there. You enter your trade here and you let it run. You could technically, and I've done this before, sometimes I'll stack positions. So I'll enter several times along the trend line. If it's a pretty trend line, this one is not. But if it were pretty, I would stack my positions, and once I go far enough and profit with one, I'll build another position. This one is not that great, but so let's say you enter here, but let's say there were retail traders that entered here, and they entered here, and then they entered here. Each time you enter, you're placing your stop loss like at the previous higher low, higher low, higher low. So if you entered here, your stop loss is there. You entered here, your stop loss is here. You entered here, your stop loss is here. So from here all the way down to here, there's stop losses of retail traders. Everybody knows that, including the banks. So at some point, it will make sense that they reverse the trade and go back down here and wipe all of these stop losses out before continuing on. They will boot you out of your trade. They will take your profits, and then it will continue up as it was going in the first place. That's why securing your profits is so important. Even if you're right, there's still what we call liquidity grabs, where every now and then the market will reverse just to take out your stop loss. That's how it gets fueled. So you kind of want to, like I said, that's why a lot of people say, like, even if the trade is still moving up, they'll go ahead and take out profits at their trade. If their trading plan was 1 or 2, they go ahead and secure their profits at 1 or 2, because the likelihood of reversing at 1 to 5 or 1 to 6 is a lot bigger. A lot of times when you get those 1 to 10 risk reward ratios, those are reversals. And reversals are like, you can find them. I'm not going to say they're rare, but it takes a high level of skill to be able to spot them. Here's a better example. So you see I have this line drawn here. That is showing that we have 1, 2, 3 times that we've hit this area. Every time we hit this line, we reverse. Every single time we hit this line, we reverse. So it hit it 4 times here and reversed, and it came back up and challenged it again. We got a wick. So right here, most people will be looking to enter because we bounced off of it again. And it's a wick, which shows that it's kind of volatile. Let's say you jump in, you do a short right here. You place your stop loss just a little bit above line so you have some wiggle room, and you're going to play this to the downside. You can play that down as far as you want, but it wouldn't surprise me if at some point the market reversed and went all the way through this point just to take out those stop losses. So we went here, we bounced off and went here, tried again, bounced off, went down here. Now, when we get ready to go back up to here, institutions know that retail traders have their stop losses placed all along here because they've been trading projections. So it would make sense that at some point they go through this line and take your money because they're in the business of making money. So this is where, greed and securing profits and sticking to your trading plan comes in. But if you don't, and you decide to ride it out and you don't have a trailing stop and you have a little stop loss, don't be surprised that they come all the way up through here just to take out your stop loss, and then they continue it. That happens a lot.
Some more questions and comments if you want to check them out.
So you close your trade, or how do you take it out? Me personally, that's when market structure comes in. Like if this is a really, really strong resistance line, ideally, let's say you entered here or about right here, the stop loss is here, and the trade's going in your favor, and you're already at 1 to 3, and you know your typical setup goes 1 to 3, you can just close out on strategy alone. 1 to 3 is something that you can pretty much do every day. You might only find 1 or 2 setups, but it's doable every day. And I used to have a TradeZella account where it analyzed my trades and stuff like that. And I always did my best at 2 or 3 trades a day. Anything more than that, and I was pretty much giving money back to the market. But ideally, what I tend to do is like if I entered here and then I became in profit here, I actually just moved this down. I moved my stop loss to in profit. I tighten it. That way I know it'll take me out in profit, even if the trade reverses. That kind of helps you be in a risk-free trade. And that's not a bad strategy to have in general. Once your trade goes in profit, drop your stop loss, and then you're in a risk-free trade. But I would definitely probably be closing it out at a 1 to 3. Overall, if you hear nothing else, your price action will show you like when to close out that trade. So like, let's say you entered here and you were following this trend, traded it all the way up to here. Your price action is telling you that you're meeting resistance right here. So that's where you close. If you enter here and you trade it all the way back down to here, I will be looking for like wicks or any type of sign of reversal. I will be looking at my candles like really, really close. You notice that like I don't have the green and red candles. I have pink and purple and they look very similar. I do that so I don't get distracted by whether it's a bearish or a bullish candle. Because I think what's more important than anything is the shape of the candle and the behavior of it and the way that it looks next to other candles. More important than the color of it. I do that on purpose so that I don't be like, oh my God, it's red, I have to hurry up and sell. Like, no, like what is the actual behavior of the candle doing in that moment? Okay, so this technically is the uptrend. So let's say I got in right here, for example. You can see that from a mile away. There's a wick right there. Let's just say I was feeling adventurous and I decided to play off of this wick. And I do that sometimes for real. If I see a wick, sometimes I'll just kind of fade it. Because that usually means it's touched the area of interest. But let's say I entered right here and I was playing this to the upside and it was going up and it's going up. This is my exit because my price action is showing me like this candle is rejected off of this. We hit this area this time. We dropped, challenged it again. Fell. We came and challenged it again. Barely got higher. We challenged it again and we still, that's my exit. Like it challenged it 3 times. So my exit is going to be where I'm seeing resistance. Because at that point, the market is getting ready to make a move. And I can't say for certain what that move is going to be. So I'm going to secure my profit. This is a 1 or 2. And I'm going home. If I were to ride it all the way up to this area, that's a 3.5. That's more than enough. And that's a rule that I keep in my little rule book. Anytime you get near an area of interest, go ahead and close out the trade and then just sit back and wait and see what it's going to do and how it's going to react to that area. The rule of thumb is when it comes to demand zones, like let's say this is a supply zone, when it touches this area and you see it fail to go through it or to get beyond it, you'll be placed in a sell order. Your short will be here and it will be to the downside. So 1 to 3 right there. If you go through a supply or any type of huge order block like that, anytime you plow through it, that's when you play to the upside. Because that means that there's enough power behind it and enough, like, I call it institutional involvement, that they have enough power to push it beyond this area. So those order blocks are really, really significant. Either it's going to bounce off of it in reverse or it's going to plow through it. And very seldom will it go into a demand zone like this, consolidate. So your price action, if you ever get stuck in a trade, you're not sure if you can hold it or if you need to sell it, just look at your price action. It should always tell you. And when in doubt, if you're in profit, close. My mentor used to say, never let a good trade go bad, ever.